A few examples of the physical presence test. So a taxpayer departing New York for Hong Kong at 9 p.m. on Sunday, June 3rd, will, because of the Great Circle route, fly north and pass over the US-Canadian border, in our example, at 11:30 p.m. on Sunday. A similar taxpayer departing San Francisco for Hong Kong at 9 p.m. on Sunday, June 3rd, the first foreign airspace they will meet after they fly out over the Pacific will be over Japan at probably around 3 a.m. on Monday. So the question is, when is the taxpayer's first day in a foreign country? For the first taxpayer, their first day in a foreign country will be Monday, June 4th, because by midnight on Sunday, they have already entered a foreign country. Whereas the San Francisco taxpayer, their first day in a foreign country will be Tuesday, June 5th, because at midnight on Sunday, they had yet to enter a foreign country, and they won't do so until 3 a.m., so their first midnight in a foreign country will be Tuesday, June 5th. The foreign housing exclusion and deduction. In addition to the being able to exclude income, foreign earned income, you can also exclude from gross income foreign housing paid for from employer funds. Now, importantly, employer-provided funds includes wages, salary, reimbursements, equalization amounts, perhaps an education allowance. These allowances are included as employer-provided funds, whatever use they're put to. Alternatively, if you're self-employed, you can deduct, but not exclude from your gross income, foreign housing costs. So, what are qualified housing expenses, and how do you calculate the housing amount that can be excluded? Well, the housing amount is the total housing expenses, as allowed for, less a base housing amount. Your base housing amount is your foreign earned income exclusion amount divided by the 365 days in a year, multiplied by the number of qualifying days in the tax period, so the days that you were in a foreign country, multiplied by 16%. So for a full year, it's 16% of the foreign earned income exclusion amount, which is set annually. So the housing amount is also subject to a maximum of 30% of the foreign earned income exclusion amount. So to calculate your housing amount, for 2018, it's $104,200 multiplied by 30%, or $31,260 a day. It's calculated on a daily basis and dependent on the number of qualifying days in the period. However, this limit is increased for high-cost locations as detailed in the relevant IRS tables. Most major cities around the world are detailed on that IRS table and have higher amounts. We'll look at a couple of examples next. So, the base housing amount for full year 2017 housing is $16,336. So for a Dublin resident taxpayer, the city limit is $38,400. So it's that 30% limit is lower at $31,260. So we use the higher city limit of $38,400. In this case, our taxpayers' actual expenses are $42,000. So the housing amount for exclusion or deduction will be the city limit of $38,400 less the base housing amount. So in this case, $22,064. In our next example, we have a Hong Kong resident taxpayer. Now the Hong Kong city limit is $114,300. Our taxpayer in this example has $60,000 worth of actual expenses. So their housing amount for exclusion or deduction is $43,664. It's their actual expenses less the base housing amount. In this case, we use the lower of of the city limit or the actual expenses. So what qualifies as housing expenses? Housing expenses include rent, fair rental value of housing provided, repairs, utilities, not telephone charges, real and personal property insurance, rental of furniture, residential parking, fees for securing a leasehold. They do not include expenses that are lavish or extravagant under the circumstances, deductible interests, costs of buying property, costs of domestic labor, pay television subscriptions, improvements that may increase the value or prolong the life of a property, purchased furniture, a depreciation or amortization of property or improvements. So if you look at what qualified housing expenses are and what they are not, there's a fairly clear divide between expenditures and perhaps investments in property that would have a value that would be retained by the taxpayer. And irrespective of local customs or the commonality of certain items such as domestic labor, they're not qualified as housing expenses. The foreign earned income exclusion is filed on Form 2555. It's due with the annual income tax return, so April 15th, for calendar year filers. You're automatically granted a 2-month extension if you live outside and your tax home is outside the US and Puerto Rico. The form is filed with your 1040. And if you're waiting to qualify for either a bona fide residence test or the physical presence test, you may wish to file and pay your taxes due and then file an amended return to claim the exemption when you do qualify to avoid the accruing of interest and penalties. There are no double benefits. For example, you cannot deduct housing expense from income that you have already excluded under the foreign earned income exclusion. Foreign tax credits. Who's eligible for foreign tax credits? These tax credits are eligible on taxes which are paid on income, salary, wages, bonus, so normal income, war profits, or excess profits taxes. They are not available for dividends and other sorts of investment income. They must be compulsory. So you must not be eligible for a refund of these taxes from the foreign taxing authority. The irrelevant income must not have already been excluded. So if your taxpayer does not make more than the foreign earned income exclusion amount and has already excluded all of their income, there is no credit available for the taxes paid on that income. However, if your taxpayer has earned more than the foreign earned income exclusion amount, the tax paid on the excluded amount is not available, but the tax paid on the remaining amount would still be available. However, your foreign tax credits cannot exceed your U.S. tax liability, and in many cases, countries' tax rates are higher than the U.S., leaving with a foreign tax credit to be carried forward. And they can be carried forward for up to 10 years. When is the Form 1116 not required? You can claim foreign tax credits without filing a Form 1116 if your foreign taxes paid are less than $300 or $600 for married filing jointly. They are taxes for which you are liable. All foreign income is passive, so dividend, interest, etc. Is reported on a qualified payee statement, and income from American Samoa or Puerto Rico is not excluded by you. Then you can claim to elect the foreign tax credit without filing the Form 1116. You merely enter the amount on line 48 of your 1040. Credit or deduction. Foreign taxes can generally be taken as a credit against US taxes on the same income or as a deduction in Schedule A, but never both. And often a credit, which reduces the amount of tax payable, is more valuable than reducing the amount on which tax is payable.